Good afternoon and welcome to the Killik & Co market update. Shares in Facebook fell over 8.5% this week, wiping the best part of $50 billion off the value of the company. To put that into perspective, that's roughly what the UK spent on defence in 2017. Shares have recovered a little bit over the last couple of trading sessions. Fall really came around when an emergent UK data company, Cambridge Analytica, misused Facebook user information, or user data rather, to help influence US presidential elections. The US Federal Trade Commission has opened an investigation as to how Cambridge Analytica was able to obtain the data of over 50 million Facebook users when it was granted express permission from only 270,000 of those users. So the issue clearly raises concerns over the protection of consumers' personal data, or consumer personal data rather, and particularly where it can be used in a big data environment to help shape or influence change in society or its behaviour. So Facebook, social media, tech and data companies all worth keeping an eye on as or if further revelations unfold. It's been a pretty gloomy time for high streets across the world, and in the UK we've seen the likes of New Look, Jamie's Italian and Prezzo all close stores, and we've also had Toys R Us and Matt Blanc go into administration, which has clearly put thousands of jobs at risk. If we have a look at the chart, we can see just how bad a time some of these retailers have had this is since the beginning of the year. And this week we've seen Carpetright take further loans to assist with short-term capital requirements, and Moss Bros and Men's formal clothing business has issued a profit warning on Wednesday ahead of results next week, which led to a fairly hefty 30% pullback in the share price. Kingfisher is the owner of B&Q and Screwfix, fell as much as 9% on reporting results, which were marred by falling sales at B&Q in the UK. The group warned that the UK market remains very difficult and that it doesn't see it changing in the near future. So the Kingfisher is also another company which is in the process of closing some stores. So all in all, retailers have been faced with consumers who are exhibiting lower levels of spending confidence, who've been feeling the pinch and continue to feel the pinch as levels of inflation have outstripped growth in wages. And this means they struggle to maintain their spending power, which is clearly not good for retailers. Let's not forget as well that the continued consumer shift towards e-commerce has also turned the screws on the high street. So all in all, there aren't too many bright spots in UK retail at the moment. US markets continue to outperform those in the UK and Europe, and this is a trend that's been in place since the beginning of the year. If we look at the chart, we can see that the US market, as noted by the S&P 500, is pretty much flat on the year. The DAX, which is the German index, is down 6.5%, and the FTSE 100 down over 9%, lower than it was in January as we moved through that 7,000 level this morning. This highlights some of the divergences in stock markets as the exporter-heavy German market continues to struggle in the face of potential trade wars and tariffs, and in the UK remains in the doldrums and relatively unloved over concerns regarding Brexit and the stronger British pound. So remember that since we have such a high proportion of revenues in FTSE 100 companies earned overseas and therefore earned in foreign currencies, a stronger pound isn't all that good for those companies. The EU and the UK shook hands on a 21-month transition deal on Monday. Further Brexit negotiations take place out to the end of 2020. So for now, at least, that should go some way to pacify those who are concerned about the potential for a cliff edge come the end of March next year. The news saw the pound move higher against the euro and against the US dollar, and currently we see sterling euro around 115 level and the sterling dollar level around 141. We've also had a latest round of UK inflation and wage data this week, which showed that the rate of inflation slowed marginally to 2.7%, but actually wages increased at the fastest rate that they have in 2 years over the 3 months to January. So this, coupled with a Brexit transition deal, has added to market expectation that the Bank of England may start to sound a little bit more hawkish over the coming weeks, and the latest data is likely provided with an additional level of comfort when they consider potential interest rate rises in May, and this is something that the market's prescribing around an 85% probability of happening at the moment. We actually had the Bank of England interest rate decision this morning where they voted 7-2 in favour of maintaining rates at 0.5%, which was as expected. The Federal Reserve has a new head in Jerome Powell, and he gave his maiden policy statement last night. He raised interest rates by 25 basis points or 0.25%, which is as the market expected. Policymakers guided that they would look to raise rates an additional 2 times in 2018, taking the total to 3 for the year. Some parts of the market were potentially looking for more of a tilt towards 4 interest rate rises in 2018 in the US, and subsequently we did see the US dollar and US bond yields trade a little bit lower over the session. That said, the Fed did, however, increase their projection projections for interest rate rises further out into 2019-2020, which may have caught some of the market a little bit offside. Chairman Powell did say that he'd be guided more by economic conditions than he would by models and forecasting and theories, which suggest that there is some wiggle room in there should it be required. Finally, looking at companies reporting next week, Canada's actually pretty light, but we will be looking out for Ferguson and for Walgreen Boots Alliance. And that's it from us. Have a great weekend, and we'll see you again next week.